Thank you very much for organizing this event, and thank you for inviting me to present my research. What I'm doing today is I'm going to present part of a paper co-authored with two other people, Rebecca De Simone and Chiara Scotti. They're both at the Federal Reserve Board of Governors. Before I do the presentation, let me say the usual disclaimer that what I'm presenting today is my views and those of my co-authors, and they do not represent the views of the Federal Reserve Board or any of the banks of the system. So let me get started with motivation. The reason why I'm excited to be here is because I've spent a lot of years investigating how is information incorporated into asset prices. And 25 years ago, we have Danielle Kotler, James Puterba, Larry Summers, Rob Schiller, who actually got the Nobel Prize for his finding, Richard Roll. All of these people basically documented that there was a disconnect between asset price movement and public information. And when I read these papers, I thought, is this really the case? Or is it the case that these people use really bad news databases? So what I'm doing today is actually using a very good news database to revisit that question. Is there really a disconnect between asset prices and public news announcements? What I'm doing is actually using RavenPack data. There is other news databases like Thomson Reuters, Bloomberg, and this is basically what we do. Before presenting the results, let me tell you the challenges that we faced and anybody who uses news databases face. In my mind, there are three big challenges. The first one is endogeneity. Basically, as we all know, whenever asset prices move and there's a large movement, then journalists try to figure out why that is the case and explain it. In the regressions that I'm going to show you, which is basically just regressing the asset price change or the return on the news, if all the news I'm picking up are those that the journalists explain what happened, I'm going to have a huge R-square. I'm going to say, wow, news really can explain asset prices, but the causality is going in the wrong direction. Basically, what I would say is that the asset price movement is what caused the news, not the other way around. And what I wanted to say is that I think RavenPack does a really nice job because they have two news categories that are called the stock price and the order imbalance, which basically address that point. They say, okay, asset prices move, and then the journalists try to find the explanation. So what we do is basically get rid of those news in the regression that I'm going to show you, because I'm trying to get at the causality. When did news cause the asset price movement? The other challenge is what are the important news? So I started saying that 25 years ago, they found a disconnect between news announcement and asset prices. And the reason, I think, in part, is that the news coverage was not very good. But what I think was very good is actually they got the important news. There were few news, but they looked at earnings announcements, they looked at wars, and they looked at macro news announcements. And I think now the problem that we have is that the news coverage is really, really good, but then it's a little bit more difficult to figure out which news are the important news. What I'm going to do is sort of narrow down the categories. RavenPack has many more categories, but we narrow it down to 21, and I think there is still room for improvement. So I think the results I'm going to show you is sort of like the worst case scenario. I think you can do much better by selecting better the important news. And then the last challenge is basically how to measure the information content of the news. And I think RavenPack does, again, a good job by giving you the sentiment. And I think there is still room for improvement. And what I'm going to show you is that I'm going to make the RavenPack news compete against what I view as the standard news source, and in particular, earnings announcements. And I'm going to compare how RavenPack does against just looking at the bottom line earnings of the company as compared to the forecast of the analyst. And I'm going to show you that basically RavenPack gives you additional incremental information from just looking at just the bottom line earnings and the analyst forecast. And the reason why I think it does is because basically it measures, in addition of what I would call the hard information, it also measures sort of soft information. Okay, So what do? We use RavenPack data. We're going to analyze only the firm-specific news. So RavenPack also offers macro news, and I think now they do Twitter as well. But we're just going to analyze the firm-specific news. And the answer I'm going to give you is that we're better off than 25 years ago. And the reason why I think we increase the percentage of the asset price movement, the variation of asset price movement, is because RavenPack captures both soft information and because the coverage is better. What I'm going to show you in the second part of the paper is that the importance of news explaining asset price movements is going to depend across time. It's going to be different across time. It's going to be different across announcement types and across different firms. I'm going to quickly, if I have time, show you sort of that the results are consistent with what I view as the Bayesian learning, a very standard Bayesian learning model. And so I'm going to look at whether the firm-specific news can explain more of the asset price movement in crisis versus regular times, whether it does a better job when you look at small firms versus large firms, and when you look at firms that have high earnings volatility, like the high-tech sector. And what I think would be interested in the future is basically see whether the management issue news have a better explanatory power for the firm-specific asset prices, or whether the journalist coverage does a better job. So I'm going to look at data from 2000 to 2012. We're going to look only at the 1,000 firms, and that gives us around 2.5 million observations, daily observations of return data. Then the news days is just going to be 300,000 of all the trading days. But you can see that there's a big improvement by only looking at when earnings announcements happen. So out of the 2 million observations, I have that earnings announcements only happen 30,000 days. I'm also going to I'm going to compare basically the RavenPack data to the IBES data, which is a database of analyst forecast. And I'm going to look at CRISP and CompuStat as well. So the first thing I do is sort of make RavenPack compete against these standard news databases. And the first thing I thought, okay, let's see how RavenPack the surprise is compared to the standard surprises that I'm used to looking at, like earnings compared to the analyst forecast, and also earnings compared as last year, same quarter. And actually the correlation is positive, but it's not super large. So it's 40% when you look at the earnings, the current earnings compared with last year earnings, the same quarter, it's 40. And when you look at the earnings compared to the analyst forecast, it's 25%. I actually think, I mean, I don't know what you think, but I think this is actually good news, because this is telling me that there is potential for RavenPack to give me something different than just the hard, the bottom line, the hard information or bottom line earnings information. And to do that, basically what I do is just regress daily returns on the different news surprises. So the first coefficient is basically the RavenPack news. So all that's telling me is that the RavenPack news on the day of the announcement is going to be whenever there's one standard deviation shock, so all of the surprises are standardized, one standard deviation shock to the news is going to give me 40 basis points of return. When you look at that compared to the IBES surprise, the IBES surprise has a much bigger impact on asset prices, but the RavenPack news has an impact that is bigger than the CompuStat surprise, which is just comparing earnings this quarter with last year, same quarter earnings. But what I find interesting is that when you make the three of them compete against each other, you see that the RavenPack news actually is still statistically significant. The economic impact goes down because, as you saw, the two of them are positively correlated, but you still have 30 basis points on top of what the IBES surprise gives you. So the first lesson is that the sentiment has incremental information to what I would call the hard information. It's better than the CompuStat earnings surprise. And basically just to give you some additional intuition of whether this is, I mean, I don't know if you think 13 basis points is large or not, but previous research has found that if you condition on both the hard information, earnings announcement news, and the soft information, you actually get pretty large momentum strategy returns. So this is from another paper. This is not using RavenPack data, but from another paper, you can see that if you have a momentum strategy where you're conditioning on the earnings or price, you sort of get around 12%. So that's 3 times 4 is a 12% return for small firms. And then if you condition on both the hard information and the soft information, you're going to have around a 20% annual return on the strategy. So the second lesson is that soft information is economically important, and that's why I think, in part, the RavenPack sentiment is important. So the answer, I didn't give you the answer about whether we're better off than 25 years ago. And basically what Richard Roll found that was disappointing to him is that if you look at a CAPM model, so basically just regressing the firm-specific returns on the market, you find that the explanatory power of the CAPM model is pretty much the same whether you look at non-news days versus news days. So basically the improvement of the market model on non-news days is basically just from 16% to 17%. So it's just 1% increase. And that's why they said, okay, there is a disconnect. So what do we find now that we have the RavenPack data? So all I did is basically do the regression on the 2 million observations that I have. This is not the CAPM model, it's the market plus some FAMA French factors, and I found that the explanatory power is around 25%. If then I get rid of the earnings announcement days, my improvement is only 1%, sort of like what Richard Roll did. And there I'm just taking those 35,000 observations. And then if you move to the RavenPack news days, so those 300,000 observations, then you see that the improvement in the R-square is better. So you have around 3% increase. So I think it's an improvement. Maybe you think the glasses still have empty, but we're moving in the right direction. So what I think is more important than just this increase in the R-square when you condition on news days is actually that you can explain asset price movement on news days. So let me show you a regression where I have the return on the 21 news categories. These are a little bit different from what RavenPack offers. Actually, RavenPack offers many more. But the news categories here, the first one would be merger and acquisitions. Then you have bailouts. You have credit ratings, dividend news, earnings news. And basically, when you do this regression, not including the FAMA French factors, you're going to get a 5% or 4.5% R-square. So that's a huge improvement when you compare that to only looking at earnings news. So if you do the same regression with earnings news, you're going to have only a 0.5% R-square. And then what I view as a big improvement is basically when you look at the FAMA French model. So basically you're taking away the systematic component of the return, and you're regressing against the firm-specific news, then you're going to have a big improvement in the R-square. So you go from 16% to 21%. So what's lesson number 3 is that the biggest gain, I think, doesn't come with the soft versus hard information, but is the increase of news. So now, instead of only looking at these pre-scheduled news announcements like earnings and macro announcements, you really include a lot of the on-schedule news. And to me, those are probably the more important news or the big market movements. So let me now go over the heterogeneous response, so that the response to firm-specific news varies across time, across firms, and across news types. Here I just decided to just put a couple of equations to sort of like understand what's the economic theory, why should the response vary across different characteristics and across time. So the Bayesian learning model is a very simple model, and I like it for that reason. And you can think of a world where there are only basically two news signals. And one news signal, I'm going to call it the market, and the other one, I'm going to call it just the firm-specific news. And each of these signals has different precision or different noise. So this row is basically going to tell me how the news announcement is related to the fundamental value of the asset. So the bigger that row is, the more information the news gives me about the fundamental value of the asset. And what's nice about the Bayesian learning model is that you're going to see that the price change, so my P1 minus P0, the price change is going to be a function of each of those surprises, and it's going to be a function of how precise each news was. So it's very intuitive. Basically, what it's telling me is that the more precise the market signal is, then the higher the weight would be on that signal. The more precise my firm-specific news is, the higher the weight. And then also both weights will be higher, the less precise the prior information I had about the firm is. So what this model is telling me is that the impact each of those news announcements have on the asset price should vary, and it should probably be higher when we're not in a crisis period, when the market news are not as important to the firm. It should also vary depending on how much information you have about that firm. So that's the prior. And basically what it says is that at small firms, probably the firm-specific news should have a bigger impact on small firms. And then it should also, if I replace basically the market news for hard information versus soft information, it should probably have a bigger impact on those firms where we think that hard information does not predict the future of the firm very well. And that, in my view, would be something like the high-tech sector. So basically, the first thing we do is let's see what's the improvement in the R-square when you look at the pre-crisis period. So here we don't include the crisis period, and what you see is that we go from 11% to 16%. So basically my improvement in the explanatory power is 47%, while before I show you that basically the improvement, it was only 21%. So basically what this indicates is that the firm-specific news can explain more of the asset price movement when you're not in a crisis, which I think is very intuitive. When you're in a crisis, basically the market or the systemic shocks are what are explaining everything. So this is during the crisis period. So before, sorry, I had this 47% increase in the R-square, and now we only have a 16% increase if I look at the crisis period. If we look at small firms, basically, you see that the improvement in the R-square is going to be 41%. So what this is telling me is that the firm-specific news seem to be more important for the small firms than the large firms. And then last but not least, we also look at the high-tech sector versus the non-high-tech. And you see, again, the improvement is 32% versus the 26% that I had at the beginning, which is for all the firms. So lesson number 4 is that the impact of firm-specific news varies across time and across firms. We find that during the non-crisis period, firm-specific news have a bigger effect, and that they have a bigger effect on small firms and high-tech firms. And I think it's a very intuitive result given the Bayesian learning model. So just to summarize and conclude and leave some time for questions, basically we're better off than 25 years ago. I think there's still a lot of room for improvement. And basically we find that the firm-specific news vary in importance depending on what firm you're looking at or what period you're looking at. Thank you.
All right, thank you. So we're open for questions. Got one over here.
Thank you. So from the standpoint of the Fed or from a Warren Buffett kind of person, what do you see as the practical implications and how big are they? I have no sense of how much these things might mean to either you or us.
So I'm not representing the Fed, so I'll answer my personal view. So my personal view is that something that we could use this, for example, is to improve our forecast of the firm, the earnings of the firm, and then you can do a better forecast of GDP. So basically, the bottom line of the research tells me that our news databases are better than 25 years ago. We see that those news have an impact on asset prices, and perhaps those news also have an impact on our forecast for GDP or future economic activity. But of course, I haven't shown you that. That's work in progress.
And similarly for investors. And similarly for a Warren Buffett type, he might be able to figure out which industries would be growing faster, or what are some other implications?
Sure. So I guess the momentum strategies has some. The momentum strategies that I show you basically tell you that you do better off. You're able to forecast better what the returns are of the particular firm if you condition on both information signals, not only on the earnings announcement, but also sort of in a sentiment.
What's the longevity of these signals? I mean, do you have to trade intraday to get the benefit, or what's the holding period that you can operate with using this sort of sentiment type signal?
So all of the regressions I show you is daily, and I'm not in the business of predicting or making money on the signal. So, and I also didn't adjust for like transaction cost. So I guess my answer to you is I don't know, but the regressions I show you are daily, so they still have an impact, by the end of the day.
Thanks. Your work is pretty similar to the Feldman, Kogan, and Richardson paper, or you're cited in there as one.
Well, I cite them, I guess, at the beginning. So this is the sonar.
This is okay. That's okay.
The sonar system, I guess, is isn't the.
Yeah. Okay. So. No, just look up.
The Feldman-Sanger.
Yeah.
Yes.
Yeah. So they found there was like an 80 when you really differentiate between good news and bad news. There's as much as 80 basis points a day in the individual returns. But anyway, pretty similar work. So thanks.
For your last result about high-tech firms, what is the definition of high-tech firms? How do you know if a firm is high-tech or not?
We look at the SIC code, and then basically FAMA has, on his website, he says, okay, this is the SIC code that belongs to the high-tech.
Basically based on the industry.
That's right. There's a question.
What was the in-sample and out-of-sample time frame?
So we don't do out-of-sample. So all the regressions I show you are in-sample, and it's 2000 to 2012. And then the crisis, when I do the crisis period versus non-crisis period, is 2000 to before 2007. Before 2007 is the non-crisis period, and after 2007 is the crisis.
Are you worried about curve fitting without an out-of-sample set?
So the out-of-sample exercise we did is the momentum strategies, but that's not with the RavenPack data. This is another sentiment data that I had.
You mentioned that you didn't account for transaction fees, but I was wondering if someone attempts to implement such a strategy, which means that you enter the market the day before and get out of the market after, did you try to compare such kind of strategy with buy and hold strategy? Whether the success returns really make you better than simply, buying this instrument in the beginning of the year and keeping it regardless of news signals?
No, we did not, but the momentum strategies are basically a zero, basically you're long short the same amount of money. So it's sort of like a zero investment strategy, but we didn't compare it to a buy and hold type of strategy.
And Clara, just going back to your initial inputs, you said you decided on a few categories of news. Can you tell us a little more about how did you go about deciding which categories of news or types of news you should actually use?
So I think we sort of used our intuition. I mean, some categories we dismissed because there were not enough observations, like CEO kidnapping was one of those that we didn't use. But actually, I'm glad that you brought that up because I would really like to talk to people during the break or during lunch about what do they view as important news. But basically, we try to choose those news that we think have to do with the fundamental value of the asset. And again, we use this price talk news as not being a news that moves the asset price, but the other way around.
I just want to categories. Can we talk about the category of the recipient of the news? Meaning, there is B2B financial news. That means it's not all CNN. It's not all.
Sorry, I cannot hear you very well. I don't know if you can.
So, touching on the subject of categories of news and the end user, we have categories of end user also. In other words, there is B2B financial news, i.e. Bloomberg, Reuters Insider Networks, and the big financial giants that broadcast internally. Should that not be weighted for the leverage effect of the trickle down into the companies and investors that are taking that news on board?
Sorry, I'm not sure I fully understand. Shouldn't it be weighted?
There are different demographics of viewers and users of financial news. There is a typical retail investor that will watch CNBC or MSNBC, and there is also the professionals, such as myself, that would watch something like Reuters Insider or Bloomberg or something designed for me to impart information onwards to my client. That is a leveraged situation in terms of the news. So should my news not attract more attention, not be weighted more than Joe Public's news?
Sure. So you're saying basically if I see news from Wall Street Journal or something like that, whether they would have a bigger impact. So we don't do that here, and it should be an interesting hypothesis to test.
I just want to make sure I understood one point you made early in your presentation about the RavenPack ESS and the IBES surprise. So if I understand correctly, let's say there's a scenario where let's say there's X number of companies in your database where earnings come a lot higher than expected. So in your analysis for a one-day average, the correlation, R-squared correlation ratio for the IBS was 0.9 something, right? If one was to just use on that particular day the RavenPack ESS rating for that and look at the movement based on that, then a correlation ratio was 0.40.
So those are the coefficients, yes. So basically one has almost 1% effect and the other one has 40 basis points of impact on the asset price, yes.
Right. Well,
But the R-square is, down below. So I guess one has as high as 3% and the other one, it's less than 1%, yes.
okay. Thank you very much.
There is another question.
You raise your Were those residual returns or?
So basically they're residual in the sense that here we control for the FAMA French factors and then we make them compete against the FAMA French factors. So I don't know if you mean by abnormal returns or excess return. Yeah.
I think now there are a couple of the data being about news data, like the Thomson Reuters or Alexandria. So, do you have any specific reason to why you choose the RavenPack data for the other data?
So it's the one that I have access to. So I don't have access to the Thomson Reuters. So I could not tell you which one is better. Sorry. But I would be happy if Thomson Reuters gives me the data. So
Maybe I can. I have another question, Clara. I'm really obviously interested in what you've been doing over the past couple decades in your research, and especially how did you become interested in news, and how did you become interested in incorporating unstructured news and unscheduled information into your research, knowing that it was soft data and it was difficult to incorporate? What inspired you, and how did you get into this field?
So, I mean, my thesis was about this, and like I said, probably it was the papers that I listed at the beginning, one of them being the Nobel Prize. So it's just, yeah, when I was doing my PhD, this is what I was interested in. So that's why I'm happy to use the RavenPack data, because it seems to give you a unique opportunity to answer that type of question.
Well, Clara, thank you very much.